Tesla, once the undisputed leader in the electric vehicle (EV) revolution, is facing a critical moment. Its Q4 2024 earnings report paints a picture of a company grappling with shrinking margins, intensifying competition, and shifting consumer demand. Investors looking for a spark to reignite Tesla's stock found little solace in the latest numbers. The once high-flying automaker is now in a battle to prove that its bold bets on autonomy, artificial intelligence, and energy storage can offset the slowdown in vehicle sales. Tesla reported Q4 revenue of $25.71 billion, falling short of the $27.21 billion analysts expected. This modest 2% year-over-year increase highlights slowing growth. Profitability was also underwhelming, with adjusted earnings per share (EPS) at 0.73 versus the expected 0.75. Operating income missed the mark at $1.58 billion, well below the $2.68 billion forecast. Tesla attributed the shortfall to rising R&D expenses, particularly in artificial intelligence, and lower average selling prices for its vehicles. For the full year, Tesla posted revenue of $77.07 billion and adjusted net income of $8.41 billion, marking a 23% decline from the previous year. A significant factor in the profit drop was the absence of a one-time $5.9 billion tax benefit that had boosted 2023 earnings. Tesla's stock remained volatile post-earnings, but managed to stay in positive territory after hours. However, the company's 6.8% stock decline at the start of 2025 signals growing investor concern. One of the biggest red flags was Tesla's vehicle delivery numbers. In Q4, Tesla delivered 495,930 vehicles globally, missing analyst expectations of 510,400. Total deliveries for the year reached 1.78 million, slightly below 2023's 1.8 million, marking Tesla's first-ever year-over-year decline. The dip suggests that rising competition, economic uncertainty, and shifting consumer preferences may be weighing on demand. Adding to concerns, Tesla's best-selling Model Y will undergo a production shutdown as the company transitions to a new version. This move, while necessary for product refreshes, could further impact near-term margins. Despite financial struggles, Tesla remains committed to its grand vision of autonomy and artificial intelligence. CEO Elon Musk announced that Tesla's full self-driving (FSD) technology will debut in Austin, Texas in June, with plans to expand to Europe and China by 2025. If Tesla can successfully commercialize fully autonomous vehicles, it could open up lucrative new revenue streams through Robotaxi services and software licensing. Musk also reiterated that Tesla's highly anticipated Cybercab, a purpose-built Robotaxi, remains on track for volume production in 2026. In the meantime, fleet testing of existing models will begin later this year. Tesla's AI-driven ambitions extend beyond cars. The company is piloting its Optimus humanoid robot, which Musk believes could revolutionize labor markets. However, while these futuristic projects capture headlines, they remain unproven revenue generators. While Tesla's automotive division faces headwinds, its energy generation and storage business is emerging as a potential growth driver. The company deployed a record 11 GWh of energy storage in Q4, primarily driven by Megapack and Powerwall 3 sales. Tesla also expanded its supercharger network, adding over 10,000 new stations in 2024, a 19% year-over-year increase. The company expects energy deployments to grow by at least 50% in 2025, making this sector a crucial piece of Tesla's long-term strategy. The political landscape is another wild card for Tesla's future. The stock surged after the 2024 U.S. presidential election, fueled by speculation that a Trump administration might ease self-driving regulations. However, Tesla's fortunes could be mixed under Trump. While looser regulations could benefit FSD and Robotaxi efforts, Potential cuts to EV tax credits and emission standards may hurt overall EV demand. Wedbush analyst Dan Ives sees a massive upside, estimating that Tesla's AI and autonomous opportunities could be worth over $1 trillion. But skeptics like Guggenheim's Ron Jusicow argue that regulatory hurdles, especially at the state and local level, could slow Tesla's autonomous vehicle rollout. To reignite consumer interest, Tesla recently launched an updated Model Y in the US and Europe. While a refresh to its best-selling model is welcome news, the more controversial Cybertruck is already facing hurdles. Tesla has begun discounting Cybertruck inventory, suggesting that demand may be weaker than anticipated. Additionally, reports of worker furloughs at the Giga Austin factory raise questions about production efficiency. Tesla's path forward: balancing growth and profitability. Tesla's future hinges on whether it can successfully transition from a pure-play EV manufacturer to a tech-driven mobility powerhouse. The company's strategy revolves around three pillars: expanding FSD capabilities. If Tesla can crack unsupervised full self-driving, it could disrupt not only the car industry, but also ride-hailing and logistics. Growing energy storage. The demand for megapacks and Powerwalls is rising, offering Tesla a high-margin revenue stream beyond EVs. Cost control and product refreshes. Maintaining profitability while rolling out new models and improving affordability will be critical. Despite near-term challenges, Musk remains confident. There is a path where Tesla is worth more than the next top 5 companies combined, he told investors. Whether Tesla can achieve this vision, or if its ambitious bets will lead to further struggles, remains to be seen. One thing is certain: 2025 will be a defining year for the EV giant.